So when we're looking at financial health, we need to make sure that we know the basics and have a financial literacy. So topic 9, section 9.4, financial literacy, is how we're going to make sure that you know what these basic things are. Now, if you've taken multiple accounting courses, you should be well situated for this. But just in case, we're just going to go over them. So, the income statement. So income statements measure, the income. So we have our sales minus costs, and that equals our profits. Sometimes you'll see that people will throw in more things like operating expenses and interest and taxes. So this is all the way to get down to our net profit. So can we determine if the company that we're looking at as a supplier, are they going to be around? So if we look at these things, this example here, $100 million in sales, cost of goods sold $68 million, so they have a gross profit of roughly $31 million. But they are spending $23 million to make that $31 million. So we have $8 million that's almost free and clear. But of course, the government has to get their share with taxes, and the banks have to get their share if we have any financing. So let's say that's $3 million. So we're down to $5 million is what our actual net profit is out of this million. Not a bad percentage, but in some organizations, they can do better. And it really depends on the industry you're in to see where the average is. So our income statement has all these different terms on it. Sales, cost of goods sold, gross profit, operating expenses, depreciation, operating profit, interest and taxes, net profit. So all of these are just different categories that you can record on. So sales, that's when things get sold, right? The cost of goods sold, so that's the actual cost of the product that you just sold, which would turn into your gross profit, right? So operating expenses, depreciation. Operating expenses would be like your employees paying their wages. Depreciation, well, you can actually, in some areas, you get taxed on the value of your equipment and things of that nature. But this depreciation is a way where you can reduce your tax liability by saying, well, we brought it for $1,000, but now it's really only worth $500, so I should only be taxed for $500. Accountants know this really well. There's different schedules and things. We won't dive into that. So operating profit, like I just mentioned a few seconds ago, operating profit is, our gross profit minus the operation side of it and the depreciation. And then finally, interest and taxes. The banks need their share, the government gets their share, and then you're left with a net profit. And your company can do whatever it wants with net profits. So some assumptions and estimates when we're looking at these things. So we have our matching principle. Accountants love to make things line up together because they have to, So they try to match the sales with the cost of goods that was related to them. You're not going to say the production of the camera that's recording this, you're not going to try to match that sale with the cost of paying the water bill. You're not going to do that because they don't coincide with each other. But the cost of this camera that's recording it, you might associate the cable, the actual plastic that's put in it, if there's any metal in it, all the electronics, you can associate those costs with the sale of this camera. Revenue recognition. So accountants can vary depending if they're on a cash basis or an accrual basis for their accounting. It's just at what point do you actually record the sale? Most companies will do cash basis because when the cash is received, that's when the sale is recorded. Some companies try to do the accrual because, well, they're not getting paid right away. It might be paid over time. So they might have had $1 million contract, but the first part of it started off with a payment of $100,000. Well, the company is going to record $100,000 because that's what they've been paid for so far. And they're only going to give out that much in goods. Why would you want to be taxed on $1 million if you only have 100,000, right? So above line and below line. So this is just where the expenses are recorded. So is it part of the cost of goods sold? Let's say labor. Do you want to throw it in there, or do you want to put it down as an operating expense? Different areas and different companies put it in different places. So depreciation, I've already mentioned. If you bought a new piece of equipment, yes, the first year you get taxed on it, depending on where you're at. So property taxes, you might get taxed for $100,000 piece of equipment. But the next year, if you're on a 10-year depreciation schedule, you'll only be taxed for $90,000, and so on and so forth until it reaches zero. And then operating profit. This is actually telling you how well the company's doing before they pay for their taxes and their interest they owe the banks. So here's a simple balance sheet. So we have our assets, cash, accounts receivable, inventory. All those are current assets. Then we have fixed assets. So fixed assets are like property, the plant, equipment, and then all of that together comes up to total assets. So that's the asset side. So liabilities. Liabilities has to equal assets. That's why it's called a balance sheet. So accounts payable, notes payable are both current liabilities. Those are debts that the company owes. Then you have long-term debt. So this is stuff that's going to take multiple years to pay off. Depends on how your company defines long-term. So total liabilities. As you see here, total assets and total liabilities don't match because we have what's called owner's equity. So the owner, in this case, has $20 million that is theirs. Now they can pull it out of the company. They can do whatever they want with it. So, because if they pull that $20 million out, it has to come out of somewhere on the asset side. The company only has $10 million in cash. So the owner would have to figure out how are they going to take that $20 million if they wanted it. So, balance sheet. We've already talked about these. So cash, accounts receivable, inventory, all of those are current assets. And these are usually only shown in dollar amounts. So your inventory would be a total inventory dollar amount, the value of your inventory. Accounts receivable, that's people who owe you money, owe your company money. So current assets, that's all the top three there: cash, accounts receivable, inventory. And then you have fixed assets, like I said, your building, the property, equipment, not stuff that's easily turned into money. It takes some time to sell that stuff. So all of these together is our total assets. Then we have the liabilities. So accounts payable. These are bills that we owe people. You can say paying for your inventory. If you get raw materials, you have to pay for it, right? So it would be account payable. If you have a utility bill, you have to pay that. That's an account payable. Then you have accruals. So this is money that you're going to pay out. For example, payroll. You know payroll is going to cost you $1 million this year. Well, you can put $1 million under your accrual, and then as it's paid, it would actually shift to another spot. So accruals would decrease, and then another category, probably payroll on the balance sheet, would increase. Just because it has these categories doesn't mean it's limited to these categories. You can have, clown fund, to pay for clowns that come to company picnics. You can do that. You can actually itemize it like that. Or you can just lump it all into, let's say, entertainment. So short-term loans. These are very short, and depends on where your company draws a line, usually less than 1 year. These are things you're going to pay. Could be a short-term loan from a bank. It could be from another company. Things like that. These get paid, will be paid off very quickly. Current liabilities, so that's all of these accounting. So the accounts payable, accruals, and short-term loans, that's your current liabilities. Long-term liabilities, depending on how your company defines it, is generally longer than 1 year. So you're going to carry it from year to year. So you have current liabilities, long-term liabilities, that's your total liability for the balance sheet. And then in order to make it balance with the assets, we have our owner's equity. Sometimes there is no owner's equity, so the total liabilities equals the total assets. So we have here, assets equals liabilities plus owner's equity, like I've been saying. So a balance sheet can help you figure certain things out. Can the supplier pay their bills? So you want to look at their operating profit, their net profit, their gross profit. You want to look at these things. Where are their expenses? Are they spending more in their operating expenses than they are on cost of goods sold? That might not be a bad thing if it's a service company. But if it's a manufacturer, that might be a concern. But it depends. If you ask the company about it, your supplier, potential supplier, they'll be able to tell you what. So is the supplier viable for the long haul? If you ask them for a couple years of their balance sheets, you can see a trend. Is it going up? Is it going down? Is it stagnant by staying the same rough numbers year after year? What is the company doing to try to change that? So, and then of course you want to make you figure out what assumptions is your supplier making. Is there a reason why they're recording things where they are? Are they expecting a huge contract to come up? Or are they expecting to have to pay off a loan very quickly because it moved from long term to short term? All these things can affect their cash flow. And if they don't have a cash flow, can they pay their bills? So why profit and cash are different? So revenue is booked at sale. So that's when you actually make that transaction and pay for it. And if you go to Walmart, they don't actually mark it as revenue until you pay at the cash register. So expenses are matched to revenues. So expenses need to have some reason why they're an expense. So if you have an expense and you're not bringing in any money, there's a problem because your cash is going to decrease. And you won't be able to use that cash for other things. And capital expenditures are depreciated. So capital, you bought a building, you bought a new piece of equipment, you bought some property. These things will decrease in value over time because the IRS lets you guys do it. So you got to look at these things. Make sure you understand the difference between profit and cash. So cash is that net profit all the way at the bottom. That money can be spent however the company wants. Profit, until it gets all the way down there, is not free to be spent anywhere. So cash comes from three types of activities. So we have our operations. Cash from three types of activities. So we have our operations. We have investments and financing. So operations, you're doing something to get this money. It comes in. Investments, you invest the money hoping it grows. That the stock market's going to go up. Or you bought another company, so you invested in another company, and you're hoping that your investment will return multiple times what you invested. And then financing. In some places, you can use financing, take that money, make an investment, and hopefully your investment grows more than what you're being charged for the financing. Kind of a scary thing to do because you need to be sure about that investment. For example, buying an investment in a home. Current rates are what? Roughly 3%. So you're hoping that that home that you live in is going to appreciate, increase in value more than 3% a year. Otherwise, you're technically losing money. So to advance, managers who understand cash flow tend to be given more responsibility because they don't just see it as numbers on a sheet. So they can take a look at it and say, oh, we can do this, we can do this, we can do this. And hopefully that's the right things to do. So if people are looking at the financial statement, they're just saying what was, where people who understand cash flow are considering what is possible. So I hope this quick overview of financial literacy works for you guys. If not, let me know. If you liked it, also let me know. I'm looking forward to making more videos for you guys, and unfortunately I can't see you in class, but soon I hope all this gets past us. All right. Thank you very much.